Hi, and thanks for joining us for an overview of Payday Super legislation changes. My name is Janine Robertson, and I'm part of the partnerships team. I'd like to start by acknowledging the traditional custodians of country throughout Australia and pay respect to Aboriginal and Torres Strait Islander cultures and to elders past and present. A quick note that everything we're talking about today is general in nature and shouldn't be considered personal advice for yourself or your organisation. As this content relates to both super and your payroll, please remember that we may not be the best source of specific information about the processes and systems that you are using. Payday Super means that from 1 July 2026, employers must pay super at the same time as salaries. The purpose is simple: reduce unpaid or underpaid super. When contributions are missed, the impact compounds over time and reduces retirement balances. A change to Payday Super makes it easier for individuals and the ATO to detect issues early instead of waiting for quarterly cycles. The change will have real consequences for employers and super funds. It tightens cash flow cycles, increases operational demands, and raises the bar for accuracy and compliance. Today, we'll walk through the changes under Payday Super legislation. At first glance, Payday Super appears to be a simple timing change, but there are additional rules and complexity to work through before the 1st of July. It will impact areas like onboarding, high income earners, and reporting. This is a significant shift for employers and super funds. Transaction volumes will increase, processing and reporting will change, and issues with super payments will surface much faster. There is no penalty for acting early. Adopting changes ahead of 1 July gives time to test systems and processes before it becomes mandatory. Let's step through the changes in more detail. Before getting into how to prepare for Payday Super, it's worth revisiting how super moves from your business to your employees. As an employer, you track hours, calculate entitlements, and hold details on employees' choice of super fund. You then use your digital payroll provider to make a super payment. This includes both the money and the required data. That payment and data flows through to a clearinghouse. Since employees may be with different funds, the clearinghouse splits the payment and sends the correct amounts and data to each fund. For example, if 8 out of 10 employees are with one fund, that fund only receives data and contributions for those 8 employees. The rest go to their respective funds. The super fund then checks the data, applies contributions to the correct accounts, and also tracks contribution types for compliance and tax purposes. Finally, the fund allocates the money to member accounts so employees can see it. Payday Super doesn't change this flow. What changes is the timing. Contributions must reach member accounts within 7 business days of payday in most cases. Another change is terminology. You're familiar with ordinary time earnings as the basis for super payments. Under Payday Super, this shifts to qualifying earnings. This isn't a major change to what attracts super. The underlying earnings base is largely the same. The intent is alignment with single touch payroll and removing ambiguity around what counts. It improves consistency and strengthens compliance. For example, overtime must be clearly identified. If earnings aren't correctly categorised, they may be treated as qualifying earnings by default. So this change is less about what's included and more about clarity, alignment, and enforceability. The key takeaway? From 1 July, you'll see the term qualifying earnings. For employers, readiness is very much an operational concern. It means your payroll system is set up for PayCycle Super and tested end to end. SG must be calculated correctly, and employee super data needs to be clean and validated. Data quality matters. New starters and fund changes must be handled accurately. If you make additional contributions for insurance, you also need correct salary and occupation data. You will also need confirmation from your payroll provider, clearinghouse, and bank that payments will meet the required timeframe from pay date to allocation. Cash flow may also need attention, as moving away from quarterly payments will change how money moves through your organisation. There are also specific considerations for new employees and when existing staff change funds. Processes here need to be tight. Let's look at the key deadlines for both existing and new staff. There are two key timelines to understand. First is the usual period. Super payments will have 7 business days to reach an employee super fund. You can see this on the calendar. But if you have a new staff member, an extended usual period is applied of 20 business days. This allows you to get that first super payment in on time while managing your onboarding processes, including obtaining super fund information. But as you can see, if you run a fortnightly pay cycle, then there will be an additional pay cycle between the first and the extended usual period deadline, which raises the question, does the second super payment have a due date before the first? In this example, because both usual due dates for the first 2 pay cycles fall before the extended usual period due date, both pay cycle 1 and 2 will have the extended due date applied. Subsequent pay periods will then revert to the usual 7-day period. This is not a requirement to delay super payments. This is a time allowance in order to get details into the system. If you can have payments made earlier, then we would encourage you to do so. There is a cap on the amount of income you must pay super on. This is known as the maximum super contributions base. It broadly aligns with the concessional contributions cap. Until Payday Super, this operated on a quarterly basis. Earnings above the MSCB don't require SG payments, although employers can still choose to contribute above the legislated amounts based on contracts or policy. Under Payday Super, the quarterly amounts will be replaced with an annual cap. In practice, this means higher income employees may reach their full annual super entitlement earlier in the year. After that point, no further SG is required. This creates a clear system impact. Payroll must track year-to-date earnings against the MSCB for each employee. If contributions exceed the concessional cap, employees will need to manage any tax implications with the ATO. The legislation also introduces a formula to calculate the MSCB, meaning it will move in line with changes to the concessional contributions cap. From 1 July 2026, the concessional cap will be $32,500, which will flow through to the MSCB. If an employee joins your business partway through the year, you will be able to continue paying super as normal. If the cap is exceeded, the employee manages this with the ATO. If you have high income employees, this needs to be built into your payroll processes and system design. The SG charge is being updated for Payday Super changes. The goal is to ensure workers aren't worse off when super is paid late. Also, to encourage employers to disclose and fix issues quickly and to increase consequences for repeated non-compliance. Charges start with the shortfall in super payments and associated earnings. On top of this, there is an administrative fee that employers will incur. If payments are not corrected after being assessed by the ATO, additional charges may apply. The ATO have stated that they want to work collaboratively to get this right, so communicating with them and making voluntary disclosures of any errors will help to avoid excess charges. The ATO retains discretion to reduce fees that might be applied. Systems will be automated and there will no longer be a reliance on employers lodging superannuation reporting. The Small Business Superannuation Clearinghouse will close on the 1st of July 2026. This will impact employers using this service. If using the Small Business Super Clearinghouse, you will need to move to another digital payroll provider to ensure systems are set up, tested, and ready. While this creates a clear burden for employers, there is significant work underway for super funds as well. We have a program in place to prepare for Payday Super with a strong focus on operational readiness. We're assessing system capacity to handle more frequent and higher transaction volumes. Our administrator is confident, and further testing is planned over the coming months. We're also reviewing exception handling and rejection workflows. Most transactions flow smoothly when data is consistent, but errors are where issues arise. Small mistakes matter. An incorrect TFN digit, a mismatched name, or a simple spelling error can delay processing. Under Payday Super, those delays become more critical due to tighter timeframes. We're investing in automation to reduce manual intervention. This is a shared responsibility. Employers and funds both need to improve data accuracy to avoid delays. Clean data upfront will prevent bottlenecks as volumes increase. We're also rolling out training for operational teams and contact centre staff to ensure consistent support. A dedicated working group across administration, risk, and technology is coordinating delivery, tracking readiness, and escalating any issues as they arise. We'll continue providing updates to support your preparation. More detail is also available in the Payday Super Hub on our website, including a checklist and regularly updated FAQs. Member communications will follow closer to implementation. We want to support you through this change, but it's also worth remembering that there are other sources of information and providers that may have the details you need, and some of these are on the screen. Talking to your accountant or looking at your digital payroll provider is a good place to start. Here's a quick summary of some of the action points we've touched on today. If you've not engaged with your payroll provider yet, this is an important first step. Don't delay. There's no penalty for implementing Payday Super ahead of the 1 July deadline. A reminder that more information is available on our website at the Payday Super Hub. Thank you for your time.